Good afternoon, ladies and gentlemen. Welcome to the third webinar session organized by the Philippine Society for Quality. True to its vision, the Society is continuously providing relevant training and certification activities, which are responsive to the needs of the industries. Today's session will focus on understanding the financial component of quality. I'm humbled to present to you our resource speaker for today. He is the past president of the American Society for Quality and the International Academy for Quality. He has been elected an honorary member by both organizations as well as 19 national quality professional associations. He was the first non-Japanese individual to be presented with the Edwards Deming Medal by the Union of Japanese Scientists and Engineers. He has also received the IAQ Founders Medal, ASQ Distinguished Service Medal, European Organization for Quality George Borrell Medal, and the Asia Pacific Quality Organization has awarded him the Armand V. Feigenbaum Lifetime Achievement Medal. He is the author of over 800 papers, videos, and articles, as well as 12 books on quality-related topics. He lives in Espoo, Finland. Ladies and gentlemen, please welcome our research speaker, Dr. Gregory H. Watson.
Well, thank you, Sandra, very much for your introduction. I really appreciate this. I feel like I'm visiting the Philippines again. We were just talking about this. It's been over 40 years since I first visited near Manila in Subic Bay with the military, and I've always had a very fond place in my heart for the Philippines. And I think I've spoken now at 2 or 3 of your national conferences. The last time I was there was maybe about 5 years ago to present Ni Flora Gachilian with a medal from the International Academy for Quality. So today we're going to talk about discovering financial components of managing for quality. I changed it from understanding to discovering, because what I realize is that for most quality professionals, what we know about finance is basically just one thing: cost of quality. And the thing is that senior managers do not respect cost of quality calculations. They resist using them. They're not part of the standard accounting methods. And while they may convince them they have a problem, they can't use them for tracking improvement. And what they normally use is the standard accounting systems of that organization. So what I want to do is talk to you about several topics. And when we talk about financial components, really we have to understand, what do we mean by economic theory? How does that work? How does accounting work, which is the process of bringing records to bear so we understand what we did? How do we do business reports so we can talk about financial efficiency? And then how do we relate working data to financial data? And then how do we think about operational costs? Because financial systems are very different than what we actually do in the operating world. And this is creating a problem for most quality professionals, because we work in the world of units and production, whereas the finance people work in a monetary world, and they work in the accounting systems. And then we'll review what the lessons were that we've learned today. So when I think about economics, it's been called the dismal science. It's people think it's boring, that it's kind of let's put it this way. My grandson is studying economics, finance, and accounting in university now. And he says, that accounting is interesting. It's got logic to it. Finance is interesting because you have to do logical moves. He says, but economics, it's just boring theory, And that's, I think, the problem. So I have a quotation here from actually a comedian, and he said, microeconomics concerns things that economists are specifically wrong about. Macroeconomics concerns things economists are wrong about generally. And he says, or to be more technical, microeconomics is about the money you don't have, and macroeconomics is about the money that the governments are out of. So as we're talking about this, we can distinguish many of these terms there. We have to understand, what do they really mean? And so I want to set the stage for this discussion and think about these three components of monetary methods at a high level. So the job of accounting is counting the money that comes in. How much do we get in sales? And we also count how much the expenses are. So what do we pay for materials or for people or for utilities? And what's left over from all of that, we consider that gross profit. That's how much money the company made. The job of finance is to decide, where do we get the money from, like for investments, and how do we manage the money that we receive? Should it go in the bank, or do we keep it in current accounts? And then what arrangement do we make if we borrowed money to make sure that we can return it to the owners as dividends or share value, or we have payback like going to a bank or a loaning institution? Job of economics is to define the monetary system of a society or a nation. And what that does is it governs the financial linkage between companies. So when we talk about economics, we're talking about supply chain economics with the companies that are providing goods to us, or the economics on the side of distribution into markets. It's also talking about the system of wealth distribution in a nation. So where is the money actually going to? Does it go to people? Does it go to companies? Does it go in the pockets of the wealthy people? As well as, how do we manage the social benefits in society? Things like healthcare or food distribution and so forth. So we have these three major topics that we need to think about. And what I'd like to be able to do is by the end of the presentation, go through so you have a basic understanding of all of them. And then we'll return at the end to the problems we have in relating this inside an organization where most of us work. So how does economic theory apply to work? And this is a quotation from Abraham Maslow from his 1954 Motivation and Personality book. And he said, what conditions of work, what kinds of work, what kinds of management, and what kinds of reward or pay will help human stature to grow healthy to its fuller or fullest stature? Classic economic theory, based on an inadequate theory of motivation, could be revolutionized by accepting the reality of higher human needs, including the impulse to self-actualization and the love for the highest values. So what economics does is it reduces everything to a monetary value. It's just about the money. So it doesn't say, how do we compare that to the value of friendship, or the value of love, or to the value of developing ourselves into better people? So those are not financial. And so Maslow's hierarchy of needs was based on this fundamental reaction against economic theory and trying to reduce everything into the world of money. So we take a look at economics, we see that there are many different ideas in there. We can talk about its beginnings, we talk about supply, demand, resources, scarcity, and so forth. And what we see is that economics is really a financially based study of national, personal, commercial, and governmental resources and exchanges. So what do we give and get? So it came out of trade. If you have something and I need something, I don't have what you have, you don't have what I have, we can make a trade, but we have to figure out then, what is the principle of exchange? So how much of my different thing to trade is worth your different thing to trade? So if we're doing it in terms of food, for instance, and you have potatoes and I have corn, so how many grains of corn is worth one potato? Or is it 1 ear of corn equals one potato? So we have to figure out, what is that principle? How do we value that exchange? So trade created a need for some sort of standard way of understanding what is that value in the trade equation. So this economic concept pertains to three things. So production, distribution, and consumption of goods and services. That was the basis of the trade problem in the very beginning of mercantilism. It also deals with the generation of income or revenue, savings, and investments. So this is the money that we get in terms of a salary, that a company gets in terms of sales. What we do with it, does it go in a bank or does it go into stocks? And we see finally that it's a system of production and consumption of resources. So economics talks about, what resources we have and how do we actually then use those resources to produce more resources, or how do we consume them and dissipate the amount of resources we have on a particular account. Now, the roots of economic thinking, where it came from, how did it evolve to the current state we have today? So it's the study of how available resources are used and organized to deal with the needs of society. This is macroeconomics. And there were discussions leading to the rise of mercantilism and trade. So the trade guilds in the Middle Ages, if you will, were all about how do we deal with trading, and the large trading companies like in the East India Company or the Canada Hudson Bay Company. Those were British trading companies. So the earliest form of economics described how trade occurred between states, and that gave rise to this mercantile class or the trading class. And that eventually evolved into classical economics. So classical economics, which is the very first foundations, refers to wealth as the ebb and flow of money. It's like the tide going in and out. And how is value assigned to that? So how do we create this value in trade? And basically, it has three principles. The first is that each person pursues what is best for themselves. So we follow our own self-interest. So it's basically greed induced, if you will. It's not about altruism doing for others, it's about doing for yourself. The second principle is the division of labor. That is, everybody has some specialized contribution that they make, which is valued by society. And the third is the freedom of production and trade. So trade then is mutually beneficial to both parties. And that assures that the best interests of society are fulfilled and that everybody's contributing to this. So the ability to trade and to have access to markets are really the entry conditions to establish wealth. If you don't trade, you only have what you had. So you never can have more than what you had in the beginning states. So this early economic theory developed out of this idea of trade mercantilism. So nations or companies thought, how do we maximize profitability from trade to satisfy the consumption of consumers? So if we have people who are wanting to buy, so they're the recipients of the trade, how do we satisfy them? So customers were involved at the very beginning. And as an economic policy, mercantilism maximizes the nation's exports while minimizing its imports. So if you are having more exports, that means that you have money coming in for the goods that you're exporting. And if you don't import as much, it means you're not spending as much to other nations. That means your nation becomes wealthier. And that's how countries like Spain or England became so wealthy, or America. And so application of this theory is exemplified through many historical acts. So we see imperialism or colonialism, or there are economic constraints that are being applied between nations. So like trade restrictions or tariffs or subsidies. So all of those are acts to keep the money inside the company or grow that balance of trade so that you have more money coming in than you have going out. And this was practiced in Europe in the 16th to 18th centuries as the means to enforce power by the more powerful sovereign states. And so in that period of time, we saw England, France, Belgium, Germany, all Italy, all expanding their impact on the world because they were then using lesser nations who had less power to fund the revenue coming in. So basically, you see, economics evolved out of this trading policy. And it was trying to study how do we have goods and services produced and consumed, and how do the wealthier nations get wealthier? Now, this thinking expanded to society. The first person to talk about this in the West was in English, was Adam Smith. But he was inspired by a French economist called Francois Quesnay. And Quesnay rejected mercantilist constraints. And he inspired the idea of what we call now free trade, which is the basis of most modern theory on trade. And Quesnay's motto was laissez faire et laissez passer. Le monde va de mieux en même. So let the world do and see. The world moves according to its own accord. And this has been boiled down to what Adam Smith called laissez-faire economics. In other words, the government should not be involved. Let the free markets reign, and the market forces will take care of themselves. And so as we start taking a look at this, we see that from that time we had a change in economic thinking. But we have to go back a little bit ways. So the first thinking about economics actually came from Aristotle, about 300 BC, then St. Thomas Aquinas around 1200 AD, and then Albertus Magnus. And what they talked about was how natural law applies utilitarian theory. You know, do what has value. That's what has utility. That's utilitarian theory. It has to deal with competition. So if two people are offering the same goods, how do they compete? Can you get a better deal from one to the other? And that then delivered rules to establish prices. And then we had this interdependence of beliefs or metaphysics. And economics set then as a basis for how do we do this principles of change. So the metaphysics is about the belief systems around how we accord value in society. Now, the first real modern book on economics, the foundation of what we call classical economics, was Adam Smith's 1777 book, The Wealth of Nations. And here he identified the morality of wealth. And so it was basically an ethical principle for him. And he established the current concept of free market, which operated according to what he called the invisible hand, responding to supply and demand to set prices. And he said it's best managed by this laissez-faire concept or hands-off. So that's the way that government should not interfere in policy decisions to change the market. And that was the foundation of the modern sense, that let the companies run the economy, they do it better, and the government just sits back and lets that happen. Now, in the Industrial Revolution, where we start seeing modern world becoming created, we start seeing mass production was changing the balance of power in business. And what the balance of power was going was from the individual to the company, because the company had the bargaining rights and the individuals could not, as individuals, then create a situation where they could argue about their economic value. And this was then the birth of unions as people ganged together to equalize the power of this trade situation so they could actually get that economic value from their labor. And so this raises this whole question: is there a moral imperative to achieve some form of equity in distribution of society's wealth? And people have been working for this ever since that beginning of the Industrial Revolution. So how do we make sure that we get a fair value for the amount of work that we get? And I think all of us can relate to that, because can I improve my salary condition or what the company thinks my value is? And so I want to be able to negotiate that with my boss. Now, since that time of Adam Smith, we had economic theory develop. And Karl Marx, who was known basically as the thinker behind communism, he was concerned about how scarcity drives economics. So if we don't have, for instance, food, or if we don't have some product that society is wanting, what does that have to deal with? And what's the conflict between the ruling class and the capital class, which is he called the bourgeoisie, that controls the production? They control the benefits and the goods, and then the working class or the proletariat, which enables it by selling their wages in exchange for the ability to make trade in that economy. So capitalism, according to Marx, would produce a socioeconomic conflict within society due to this uneven distribution of financial benefits, and that people would fight back. This was the emancipation of workers Karl Marx called for. That's setting the workers free from this because they don't have the constraints of capitalists telling them what to do. So this was the whole system of ideas or thinking that's behind Marxist economics today. Now, Thomas Malthus was a British man who was studying how production of food results in an increase in society well-being. And he observed that they're called the Malthus curves about the growth of society. And he could project ahead and say that society will grow on this rate. And at some point in time, there will be so many people that we will have this growth in population expanded so that the lower classes, where we have more people, will start experience hardship. They will not have the ability to feed themselves. They'll have more disease. And that this scarcity of foods and the ability to produce foods would therefore limit its production. And there would be this uneven growth that would lead to basically a setback for society and the demise of people. People would die because of this problem. A little later on, we saw Leon Walras and Alfred Marshall applying methods of statistics. And they said, we can actually create a mathematical model that describes these movements of money, the impact of these decisions. And they started defining principles like supply and demand, the economies of scale, marginal utility, and cost of production. Say we can actually express those in numbers. And so we now have this conversion where the ideas move from theory into a mathematical form and could be expressed in numbers. And then it became sort of like a quasi-science. It's not really science. It's just a quasi-science because they're using money. They're using numbers to express it. So how is economics structured? So we have this thinking developed. So how did we get to the current state of economics? Well, we see that there's, first of all, macroeconomics. And this is the study of wealth in society. So how do employment, wages, prices influence the growth of a nation or a social system in that nation? And it studies the balance of trades between nations or the productivity of a nation or the relative contributions of different industries to the gross national product, which is the total amount of goods and services produced in a nation. And it deals with this aggregate performance in a national economy. So as we start aggregating, we're aggregating the value from many different firms in many different types of industries. So we call those economic sectors. Now, microeconomics is going inside those companies to study what are the resources and financial flows inside those companies. So here the focus is on the decisions that individuals as people or that companies make about where they get their resources from, what's the price of goods and services, and it's thinking about supply and demand and how that forces us to define a price management system based on that. And we're seeing that this is dealing with the local economic conditions of a firm within a particular industry and usually within its markets or its nation if it's a national organization. And so it's constrained to one company, one firm, and its local markets. So microeconomics basically creates a competitive firm, a competitive company. Macroeconomics describes how well a firm's industry operates in the society. So it's a much broader idea in terms of its application. Now, we have to distinguish then economics from finance. So if we're talking about finance, this is a term that describes the managing, creating, and study of money and investments. So it's dealing with capital acquisition. So where do we get the money from? Where can we get investment money if you were to start up a business or expand a business? Finance also refers to the system for the distribution and flow of money, the investments by banks, financial institutions, and the assets of companies. So companies can, for instance, put their money in a bank. They can keep money in banks in different companies or countries, rather. They can invest in buying back their own shares. All of those are financial decisions. So financial theory is more expansive than economics. It's applying to disciplines of management, accounting. It's got applied mathematics as well as economics in it. And it's trying to understand how assets and liabilities over time and across multiple taxation regions can operate. So it values money based on its present value as well as what it will be valued in the future, called the future value. And so we see that there is a difference in money you have today versus money you might have tomorrow. So John Maynard Keynes is known, if you will, for the beginnings of the very modern economics. And he had economic theory based on monetary and fiscal policy, or money policy. How do we manage economic recessions and depressions? And he's still basically considered influential in how we look at the ebbs and flows. That's called Keynesian economics, if you will. Milton Friedman, though, however, rejected Keynesianism, and he advocated putting more money into an economic system. He says that lessens the need for government intervention. So as we start seeing these debates in countries today, do we do an economic stimulus? So if you give people more money, then the government doesn't have to do as much. So he was applying Keynesian financial structure, but he rejected the conclusions that they created. So this is called neo-Keynesian economic theory. And this is what we're actually having today as the driver of the logic in what's happening in society. And so we start seeing if we give more money to people, people will spend it for what they need. If you give more money to wealthy people, they will tend to invest it and do something else. But that doesn't actually trickle down to what you as an individual have available in terms of resources for normal living expenses. And so we see that finance is really maximizing the owner's shareholder value. It's not maximizing the value to the people. And so as we start seeing this, there's a lot of different questions coming out about finance. Now, the third term is accounting. So the question is, how does accounting report economic value? So Nobel laureate Gerhard Herzberg said, there's nothing wrong with good accounting, except that it does not necessarily lead to good science. So accounting is a very rigorous structure. It's relied on, but it is not scientific. There is a lot of assumptions in there. There is a lot of estimations in there, and it's not real calculations of what we would call the scientific study of what's happening in an organization. So let's understand then what we mean by accounting. So the performance of money in an organization is really what we're talking about. So the money coming in, how much money we have available to spend on current goods, where is money coming from, and how do we expend it? So if we're talking about economics, it's describing the flow of money. So accounting accounts where it's going. Okay, so how did it come in, and then where did it go once we're inside a company? So we talk about accounting. Accounting is measurement, processing, and communication of financial information about some economic entity. It may be a family or it may be a company. And accounting is speaking the language of business. So it's said to keep the score or managing by the numbers. Those are all terms used for thinking about accounting rules. So it's providing, if you will, a system of recording, reporting, and analyzing financial transactions of an organization. And that's done for purposes of understanding your own records as well as reportings for government. So there are standard rules so that governments can interpret what different organizations and different businesses do with their money and how much taxes they should pay. So it summarizes the bookkeeping records. So bookkeeping is the record of money in and money out. And it also gives us the analysis and verification and reporting of the results of what we do with that money. So modern accounting evolved over time also. And the initial focus was just on paying workers and making them efficient. And here we start seeing the changes happening in the late 1800s. And this is, again, aligned with the Industrial Revolution. So Emil Garkey and John Manger Fels wrote in 1887, Factory Accounts, Their Principles and Practice. And that was the very first textbook on cost accounting in the world. So it applied cost records for what we call double entry bookkeeping. So that means I have one record for income and one record for expenses. And it also established the difference between fixed costs, costs we have all the time that never vary, and variable costs, which change as a function of the number of transactions we have. So how many sales we have or how many units we produce. Those are the variable costs. So Frederick Taylor, who we know for his Principles of Scientific Management, actually was writing about this same idea, shop theory. So he wrote about the piece rate system in 1895 and shop management in 1903. And he was brought up the idea that there is a best way to do costing and there's a best way to do work, and we should look at having that best way applied to manage the productivity of work for what we pay the workers. And so his piece rate system basically saying we're going to fix the amount of money we give to workers based to those variable costs. So we have one piece going through a factory, and we pay each person for just that piece of labor. And so that was the theory behind piece rate systems. Change in this came from Harrington Emerson, who wrote Efficiency as a Basis for Operations and Wages in 1909, and then the 12 Principles of Efficiency in 1912. And what he was looking at was saying that what we should actually talk about is, how can we reduce costs by understanding where are the inefficiencies in work. And actually his 12 Principles of Efficiency in 1912 fundamentally parallel exactly what we mean today when we talk about total quality management. And he actually inspired Dr. Feigenbaum's work when he was talking about his book, Quality Control, in the 1946 when he first wrote it, and 1951, and then in 1961, it changed to Total Quality Control. So Dr. Feigenbaum wrote an article in Harvard Business Review in 1957 that actually brought the term, and he moved then or shifted his book title to Total Quality Control. And the idea is that what accounting will do is deliver maximum prosperity. And those are actually the words that were used by Frederick Taylor in his Principles of Scientific Management. We do scientific management, he says, so we bring maximum prosperity to the worker and to the firm. And so this is done through the productive system. However, it never actually required equitable distribution of the benefits. If we read that Frederick Taylor's book, Scientific Principles of Management, he basically said, he gave an example of a worker named Schultz. He says, if we pay Schultz too much money, he's kind of a lazy guy and he'll just want to go drink. And the next thing we know is he will not give us a first-class day's work. So we should share some money with him, but keep most of the money in the company. So that sort of logic depressed the salaries and meant that most of the value produced in an organization would go to the organization itself and therefore to the ownership rather than to the employees. So next movement we see was basically Alexander Church. So Alexander Church in 1908 wrote The Proper Distribution of Expense Burden. And then he also wrote Production Factors and Cost Accounting, Works Management in 1910, and 1914, Science and Practice of Management. And he was developing a system of accounting based on these principles of scientific management that we're developing. And he wanted to assure the production of parts efficiently, as well as the profitability of the firm using a documented, structured accounting system. So he started moving it more in that direction. Henry Gantt, you all would probably know as Gantt charts. So you're doing these scheduling charts like with Microsoft Project, for instance. His book in 1919 called Organizing for Work created the Gantt chart. But that chart was originally how do we assign responsibility and measure performance over time, and rather than just have an accounting control system. So this is now getting into the idea of budgeting and how do we assign then money over time for the work that's being done. G. Charter Harrison made a very big impact, and he was actually an industrial engineer. He wasn't really a financial person, but he had to figure out how do we calculate standard costs and accounting procedures that would allow us to estimate what profit or pricing we should do. And so he wrote a book in 1921 called Cost Accounting to Aid Production, a practical guide of scientific cost accounting. So this was basically this concept of what we call today standard costing, or costing based on the average costs we have. And that was one of the fundamentals that created the core of thinking about the accounting systems. So by then we have the basic elements of what we call standard cost accounting have really been developed. Next, we see James McKinsey. He's famous because he was the founder of the McKinsey Consulting Company. And he wrote two books. And one of them was Budgetary Control in 1922, and another was Managerial Accounting in 1924. And he said that we have to have an ability to analyze these decisions, these finances, the money impact, to figure out how management can make better decisions rather than just making an efficiency decision by an engineer. So maybe decisions about how do we enter markets or what products should we introduce. So it wasn't just about the factory engineering decisions, which are the ones that we tend to think about in terms of what we call cost of poor quality now, but it was also about the decisions about what markets, what products, what collaborations or partnerships, and how we set those up. And those are about managerial accounting. A very big contribution came from somebody who's actually the least known of all these people, and his name was F. Donaldson Brown, and he created what we call ratio analysis, or the accountants call these the efficiencies. And so he created these ideas like return on investment, return on equity, return on capital employed, and so forth. And how do we analyze budgets, and then how do we analyze what we get from our actions compared to what we had put in. And this method is typically called the DuPont method. His boss was the CEO of General Motors at that time, Pierre DuPont. And after the First World War, the General Motors Corporation needed money. They no longer had any support, from the Defense Department, so they needed money to build a commercial product. They didn't have it. But after World War I, DuPont, who'd sold most of the explosives that were used in the war, had a lot of money in reserves. So General Motors went to DuPont and they said, "We'll sell you some of the company in exchange for cash." And one of the requirements was that they take on a DuPont executive. So Pierre DuPont moved from the DuPont Corporation, which is a family corporation, to take over GE. And he brought then with him F. Donaldson Brown. And he had a problem that how do I actually evaluate profit when every division of General Motors, so Chevrolet, Plymouth, Pontiac, all of them had different ways that they calculated profit. And so F. Donaldson Brown had to figure out how do I actually do this without looking at the money, but have some way to figure out which organization is more profitable. And that's what these ratios of the relative efficiencies of those companies were based on. So he took that out of looking at absolute values of profit, taking a look at relative to activities or decisions. And then we see our favorite contributor from the quality community come along, Walter Schuhart. And in 1931, he wrote The Economic Control of Quality of Manufactured Products. And this was one of the things that I was studying in my doctoral dissertation. And I found it very interesting. If you go back in the history of Western Electric Company, which is where he was working, that his boss's boss had an objective in 1930 to actually get economic control of quality or get the economics of the country under quality control. And so Schuhart's book really only talks about economic control on 2 pages. Now it's over 700 pages long. So the title is actually, I think, more of a fulfillment of his boss's objective to make sure he got a bonus than it was actually what Schuhart was talking about. Schuhart was really talking about the system of control and how can we use mathematical principles to understand how do we control those productive systems. So he was concentrating on production efficiency, economic control by emphasizing control of the processes for production using those statistical methods so we get a predictable result. So what he wanted was predictable result in terms of level and stability of the process. So that's what we know Schuhart called assignable and unassignable variation. So can we figure out what is creating the variation or movements that's not expected in the performance? So we start seeing then these financial and operational methods both defined variance, but they meant something totally different for it. So if we go into the company and we start taking a look at F. Donaldson Brown's definition of variance, it's the difference between planned and actual. And so, if I planned to do this and I didn't do it, I had less, I had a shortfall. If I had over, I had a windfall. And so the question is, why can't we keep on plan? And many people say that that's really what you should do today. We should be delivering on plan. When you deliver on plan, the stock market benefits you. If you deliver slightly above it, they think you're great. If you deliver too far above it, they think you weren't planning properly. So maybe you didn't use the resources the right way, so it actually brings it into question. Now, on the manufacturing side, most of us know that variance is the mean squared difference from the mean. It's a totally different concept. It's purely mathematical about the distribution of the data around its central tendency. Now, out of this has arisen a concept of how we manage finance in any enterprise, any sort of organization. And what we see is we have tax accounting, and that's a special branch of financial accounting. So what tax accounting is doing, it is giving the records of how we keep records to pay taxes to either the nation or the city or the state that we're in, whereas financial accounting is based on cost accounting. We have data coming in, and we want to understand, how do we do this bookkeeping record? How do we manage these costs? And then how do we evaluate performance in that system? So this is also about cost measurement. So we come to the other side here, we see managerial accounting. And so managerial accounting is either trying to understand what happened in the last month or estimating what could happen in the future. So it's planning and decision support. And this structure is coming from the International Federation of Accountants. So it is actually their description of how these ideas work together. So if we start seeing these distinctions in accounting, we see, first of all, we had bookkeeping. So that's the activity to keep financial records of a business for routine income and expenses. So how do we record it? Cost accounting is recording the business costs in a way that we can use to improve how management is working. Tax accounting is an accounting action dealing with preparation of tax returns and calculating tax payments, so we minimize the amount of tax we have to pay, or the tax liability a company has to pay to some governmental entities. Financial accounting is recording, summarizing, and reporting of transactions over an accounting period, and it includes the preparation of the financial statements. So this is where we get the idea of a balance sheet, or the income, profit and loss statement, or the cash flow. And then managerial accounting is talking about, how do we have a process for identifying, measuring, analyzing, interpreting, and communicating information about finance and cost to make informed decisions for enhancing business controls. So we take a look at financial accounting. We want to understand, how does it actually work? So I want to try to demythologize a little bit this top tier, because we see all of these reports, balance sheets, P&L or profit and loss statements, cash flows. What does it really mean? So the idea is that executives manage the bottom line by cutting costs. So the bottom line is how much expense we have in the business. They also manage top line by growing sales. So top line is about market growth when we're talking about it. So managing organization finances means we have to learn this language and learn what is the logic in this reporting system. So organizational efficiency, or cost control, is modeled using the cash flow of income and expenses, money in and money going out. And it's essential to learn how these changes in these flows will influence the organization's profitability. So an example of this will help. So what I want to do is show you in a very, if you will, naive or simple way, how the organization is actually operating. So here, what I want to show is a simplified view of an organization. So if I have a product and I'm selling it at $100, and I want to improve performance. So if I can move that sales price 10%, that means it's going to $110. And that means I have a 10% improvement in sales. So what does that actually mean in accounting, everything else being held stable? So if we have a cost of goods sold, so that's how much we pay for things, of $75, that means we have an increase there from $25 to $35. And then we have selling, R&D, administrative expenses. So these are the amount of money we invest to get the sales, or to design the products, or to manage the organization. And so if that's fixed at $14, We then move our operating profit, which is the result after we subtract this selling from the gross margin we have an operating profit of $11, but that moved to $21 with that 10% change in sales. So we actually get a 91% profitability increase. So this is why setting prices is so important for organizations, and why they'll go do price studies to find out what is the price tolerance ability of a firm. How much will people really pay? So if I can move the price up a little bit, I become exceptionally more profitable. Now let's take a look at what happens if we maintain the cost of goods sold. So here we have the 10% savings there. So we've decreased the cost of goods sold by 10%. So that means we have now a gross margin moving from $25 to $32. And if we subtract this, we move sales and administrative expenses. We see we've moved from 11 to 18, or 68%. And this is why organizations say we're going to reduce the costs, and we keep focusing on taking costs out of the system. And that's because that markets don't really allow you to just freely move prices up. People will not tolerate that extra price, and they'll want to find something else to invest in, or an alternative company to buy from. And so this is one that is under our control. We control it in the production cost systems. So this is usually the first place that management looks for getting long-term sales, and it has a very big impact in terms of this bottom line of operating profit. If we take a look at the last one, so let's say that we can't move the sales price. Let's say that we've already squeezed out all of the cost. Then the last element is this what's called SAG, or Selling Administrative General Expenses, which includes R&D. And here, if we take a 10% improvement, we're moving it from 14 to 12.6%. And now by doing that, we have the operating profit improving 13%. And so this is more along the lines of discretionary choices that management can make. So we don't advertise as much. That's selling expense. If we're going to launch a new product, we don't do it as expensively. We cut back on R&D funding. We don't launch as many new products, so we invest less in that. We take a look and we take down administrative expenses. So people hold controls on travel, or they hold controls on training, or other expenses that they can actually choose not to do. Now, those strategies may sound very familiar to you, and that's because those are the last discretionary expenses management has to, quote, tighten their belt. And here we see it actually has the least impact, but it can be very big. Even a 10% shift there can have like a 13% impact on profitability. And this is why when we start seeing economic times getting difficult, these are the changes management tends to make, because they can be done rapidly, and they can be done under their control totally. Now, the impossible dream is do it all at once, and society wouldn't let us do that. But if we did just have 10% improvement in all three of those categories, we end up with a 272% improvement. And so this is one of the lessons that they learn if you go to controller school, and you start understanding what's actually managed in that organization, that you have to manage all the components of the financial flows to maximize profitability. Now, as we take a look at this, we see there's a number of these definitions in here. Now, I'm not going to go through all of these. They're here for your convenience. You can take a look then at the PDF and go back and refer to them. But we've talked about them a little bit already, so they're just here for your reference. So another question is, why is the chief financial officer so important to executives? And the job of the chief financial officer is to provide performance reports to the governance body. That's to the owners. So in a family, it's the family that owns the company. To a company, it's the shareholders. And they identify for them what is the performance. So that has to be done objectively. So even though they're on the management team, they report to the board of directors. And accounting systems were developed to report profit and loss and calculate taxes. So those managing the controlling functions meet legal and ownership requirements. And they also help management make better decisions that will optimize those particular outputs. So that's the job of the CFO. And that person reports to the CEO's boss, the chairman of the board of directors, and to the organizational investors. So they have an external reporting capability. So the CEO of a company, the chief executive, needs to work with them because the people who write his performance or give him his bonus are actually getting their numbers from that particular person in the company. So a CFO has an extraordinary, if you will, impact on the decisions made in the company, and they're managing that in numbers. Now, I've had discussions with a number of CFOs over the future. And here are some quotations. He says, I often find that at times that our accounting methods either work against our improvement activity or mislead our focus. Well, that doesn't give me much confidence in our accounting. Another one said to me once, it's only a 1% problem. We can ignore it as it will cost more to correct that in a process than we pay in warranty costs. So let's accept that we'll just pay a warranty expense. Really? Is that a good idea? That's wasted money. We don't have to worry about bad parts coming from our suppliers. We can just charge them back as this is restitution for a poor contract performance. So if the supplier makes a mistake, then we'll just get the money back from them. We won't have to pay for those parts. Well, that really doesn't account for everything, and it certainly doesn't account for the impact of bad parts or failures on our customers. Another CEO said, if it doesn't matter if we have either a little above or behind the cost estimates, it all averages out in the end. And I said, really, are you serious? And what I find is that many of the CFOs actually have a very naive view of how the world really works. And if we take a look at this, the traditional decisions of an executive are act quickly, show the financial returns as rapidly as you can, and then have some sort of easy implementation of management. So they want to have results in the accounting report periods that go to their boss, the shareholders or the tax, which is quarterly and annually. And so what we start seeing is that they look at a very simplistic decision process. So how difficult is something to implement? And then what is the speed of implementation? And so what I've done is I created a matrix here. This was published in an article I did in quality, the Journal of Quality and Participation in January of 2021. And I say, easy things to do. They can be accomplished fast, 1 year or less. Easy things, 2 to 3 years or slower, over 3 years, and then more difficult things. And what we see is that executive decisions tend to move to this fast and easy. So start a new sales campaign, advertise more, we can get the market moving. Change the pricing, people will buy. Discontinue a product or service that wasn't making profit for the company. Change the incentives, increase the commission or the discount structure for buying. Reduce the budgets, replace the management, downsize the organ, close facilities, squeeze suppliers on cost, pricing, or discounts, or increase or reduce the debt. So all of those are things that you've probably heard about, and that's because they get the financial cash flows moving rapidly, like within a quarter. As we start taking a look at some of these, take over a year to start seeing the change happen. So I'm not going to go through all of these, but basically it's this quarterly financial reporting that drives decisions to the near term, and it's based on ease of implementation. It's not necessarily based on what is right for the long-term strategy of the organization. Now, when we're talking about responsibility for accounting, we have these terms, fiduciary responsibility. And this is basically responsibility of what we call stewardship on behalf of the owners. So a fiduciary is a person or a firm, like a bank, a financial institution, an auditor, in whom another person has placed their utmost financial trust to manage and protect their investment, property, or money. So they act on behalf of the owners of that property and serve as an accountable person. Fiduciary responsibility is the primary responsibilities of a fiduciary. It's for managing the assets entrusted to them as a steward, so that's holding someone money for themselves and managing it for someone else, in a way that is solely in the interest of the owners and beneficiaries. So we're managing this, and it's just for your benefit. In other words, you're not making any money on the side. You're not playing any games with that money for your own benefit. So fiduciaries must act as prudently in order to minimize the risk and maximize the return for the owner. Fiduciary accountability is the checking up on how well that person is actually doing. So a person will be liable to count if they're proven to have acquired a profit, a benefit, or a gain from that relationship by one of three means. So if you've done one of these three things, you're going to be held accountable. So if there's a conflict of interest, so you can invest money in a company and you choose to invest it in your family's company rather than another one, which may be better. Or if you have a case where there's a conflict of duty between one or another, or by taking personal advantage of that fiduciary role, like embezzling the money. So the fiduciary acts as a legal trustee on behalf of another. The biblical term is a steward. So you remember perhaps the Bible parable of the 10 talents. So this is about fiduciary responsibility. So now we have to think about, we've got the situation, we understand the three elements of finance, economics, finance, and accounting. So how does business report to its owners about financial efficiency? So Anne Leslie Cotton wrote in a book, From Poverty to Power, in a speech actually, she talked about financial literacy is inextricably connected to control over one's future. If we don't know what finance is about, we've lost control of the future. Somebody who does will control the future for you. And so we see that there's a number of different charts and ways we report things. So there is the profit and loss statement, the P&L. There is the balance sheet. There is the cash flow. So each of these has a different record for a different purpose. So the P&L is the accounting record that we use to summarize revenues, costs, expenses in a particular period. The balance sheet is what we talk about assets and liabilities. So the first is revenues and costs, second is assets and liabilities. So what's the money that we have, or the wealth? The cash flow is the actual amount of money received and outgo, and it's the liquidity we have as an organization. In other words, can we pay our current bills? Can we pay the salaries? Can we pay our suppliers? If we don't have enough cash on hand, that's called working capital, then we basically will be going out of business. So how does finance report this bottom line, if you will? So we see there's a number of things. There's gross profit. That's profit after we've subtracted the cost of goods sold. There's net profit, where we start seeing that we have taken out things like maybe we have some discounts that were not in the gross profit, and that we saw before. We also have shareholder value, and that's the cost after we take this out of the net operating profits after tax. And so then we can talk about earnings per share, how much money the owners would get for each share of their money. And then we have this EBITDA. So I really don't like this. And it's a measure of profitability that judges the ability to generate cash flow for owners and evaluate operating expense before you pay taxes or interest to the banks, or there's any depreciation or amortization. And Warren Buffett made this comment. He says, amazing to me how, now Warren Buffett is one of the wealthiest men in the world, and he's an investor. And he says, it's amazing to me how widespread the use of EBITDA has come. People try to dress up financial statements with it. We won't buy into companies where somebody's talking about EBITDA. And that's because you're asking people just to worry about this cash flow and not to worry about the responsibilities you have for interest, tax, and depreciation. Because what happens in a corporate treasury function is that they play games and say, where do we decrease taxes? How do we stop paying taxes to governments where we should pay them? We want to pay them to a different government where the tax rate is less. And so it's only managing those things, not as a social institution, but as a way to optimize the company. Now, Peter Drucker talked about this accounting record, and he said, until a business returns a profit that is greater than its cost of capital, it's operating at its loss. So cost of capital would be the amount of interest we pay if we went to a bank. So if we can get a loan at a bank at 10%, that means we have to receive more than 10% on our investments to be able to really make money. He says, if we return less than we devour in resources, we're not creating wealth, we're destroying it. So in other words, the investor could get more money from the bank by just depositing there than they can by giving it to the company. So the company should be able to give them something more for the risk that might happen in terms of the loss. So there's commonly reported indicators of the company, and here are the calculations. Now, they're just, again, for reference. We don't have time to go through those and do the math. But basically, profit accounting reflects maximizing the return of value to investors and owners, and that implies minimizing the return of benefits to workers and employees. I didn't like that. So we start seeing this building up over time from the very beginning of accountants and trades, that the whole system is there to maximize the return and the calculations for the institutions, not for the individuals. If we start distinguishing productivity from efficiency, we see we can have two different measures of this. So productivity measures output of an organization based on input measures. So we have effort and we have results. And so operational productivity is describing the volume of output that is available to ship to customers. So we think of that as unit volume. So that's how we measure in our work processes what's going on. We take a look at the production and we measure that in units. Sales efficiency is about the amount of value sold in a month, and it's divided by the labor hours or the time committed per month. And so this is cost per labor hour. And so that's the sales efficiency of the organization. So how much revenue we get for the amount of labor we have in the system. Now, that's actually no longer a very valid measure. Now, it was when this was created in the 1930s, because human cost was approximately half the price of a product. Today, material cost is half the price of a product. And what we see happening back in the 30s was we had organizations. So the Hawthorne factory, which was the largest factory in the world in the late 1920s, early 1930s, they had 60,000 workers. 17,000 of those workers were quality inspectors. So as we eliminate the inspector class, what's actually happening is we're reducing the cost of labor. Okay, but as we take a look at this, if we take labor out of the production equation, we start automating, we take labor out, what we have actually done is we still have a process that is embedded based on labor rates. And today, labor rates in many companies are less than 10% of total costs. So why do we use a 10% factor as a driver to indicate how efficiently we're doing? So that's a really good question when we take a look at this, because those decisions are embedded in the logic of the 1930s. We also have to think about, calculating talk time. So this is an indicator that we use in planning production. So it defines the interval in production timing between the start of one unit and the initiation of the next unit. So this is how fast we start these things. And it's the average schedule time necessary for producing one unit of production to meet the production demand of the month. So Takt is a German word. It means music beat, clock ticking, heartbeat, a conductor's baton for an orchestra or a metronome. And talk time is often confused with cycle time, which measures the actual end-to-end time to produce the unit. So when talk time is less than cycle time, production will be able to increase the production loading. So we can see we have calculations: necessary production per day. So what's the required number of days? And talk time then is actual working hours divided by necessary production per day. Another formula is cash conversion cycle. So this is talking about how long does it take us to actually get money into the organization, and how do we convert cash, if you will. So it includes the formulas for receivable turnover, how rapidly do we get the money in, inventory turnover, how rapidly do we turn over the money, and then the turnover that we have on purchasing debt. So the amount that we might have in terms of the receivables that we have to the suppliers. And so again, we have a whole set of formulas for these. And we start seeing is that these systems now are looking at these ratios in different ways. And we start seeing it's a lot of ratios that go into this. And there is a complexity here in how we look at things. And one of the things we see is people use in Six Sigma. They've introduced the idea of Little's Law. Little's Law was a law based on queuing theory. So that's about the idea of how long items are lasting in a line or a queue. And so this is basically roughly right because it's based on averages. So queuing theory was created by Professor John Little at MIT during the Second World War. He wrote a paper about it in the late 1940s. And it's a formula based on average performance. And he basically said that the expected number of people waiting in a line is governed by this. So the long-term average number of customers, L, is the length of the queue, and a stationary system. In other words, it doesn't change. So that's within a month, basically. So if we take a look at the average for a month, it's equal to the long-term average effective arrival rate. So that's the orders coming in, lambda, or the queue throughput rate divided by the average time, W. So we see average cycle time is equal to work in process divided by throughput rate. And as we're looking at this, we start saying, we have an understanding that there is a roughly right way of calculating this. But what we have done now is we've got an average for the month. We don't have where we work in terms of the actual production on a day-to-day basis. And that's where we have to take action to reduce costs. And so how is work data related to financial data? So we see cost is more important than quality, but quality is the best way to reduce cost. That's what Genichi Taguchi talked about in his book, Introduction to Quality Engineering in 1986, when he was introducing the idea of quality as a loss to society. Now, the problem with the financial metrics is basically based on what we call the flaw of averages. So Jay Gould made this comment. He said, our culture encodes a strong bias either to neglect and ignore variation. We tend to focus instead on measures of central tendency. And as a result, we make some terrible mistakes, often with considerable practical import. So the flaw of averages is basically saying that all plans are made on average customer demand, average completion time, average interest rate. And on average, they're wrong, because they don't include the variation, because that is what upsets the flow of the averages. So if we take a look, you've all seen this curve before. We see that we have a curve, defects coming down, the cost of control coming up. The economists say, at this saddle point here where they cross over, that's the point of diminishing returns. And the conclusion from this model is we can have too much quality, so it's costing more to get it, and we can have too little quality. So it's under quality and over quality conditions have been created for what's been invested. So under quality is cheating your customers, that you're not giving them something that's good enough. Over quality is cheating your shareholders because you're paying too much to give the customers. So the logic is you should operate right at that point of diminishing returns. Now, if we take a look at this, where did that model come from? And the model actually came out of the 1950s. Dr. Duran was one of the first to use it. And basically, we start seeing that the two functions there, one is eliminating defects, and the other is the cost of that process for defect elimination. So the defect rate at the time that model was created occurred because we added more inspectors. Okay, so as we add more inspectors, we catch more poor quality inside the factory, and we ship less bad quality to customers. But there's a cost. That's the cost of the additional labor of the inspectors. And so the cost of control was the additional salary. So if we take a look at that chart, that's really not an appropriate way to model this, because it's a very expensive solution and it's not a permanent change. We didn't fix the process. We didn't get rid of the problems. And do you think that you can have a high level of quality by adding more inspectors today? I don't think any management will let us do that. So we have to do something different. And so Deming observed this, and he said basically the cost of quality may be unknown and unknowable. So what the quality community did was they came up with costs of quality. So that was first introduced by Feigenbaum in 1946. Crosby then talked about it, and he gave credit to Feigenbaum for it. But we start seeing people doing this. ASQ has a cost of quality committee. But Deming said the cost of quality may be unknown and unknowable. It's not scientific. And how can we count these costs? So what is the cost of joy of work or pride in production? What is the cost of resources spent for decision alternatives not in the best interest of the company as a whole? What's the cost of obsolescence that's not borne by the producer, but it's borne by society as we have to dispose of these durable goods? What's the cost of providing unresponsive end-of-life healthcare? What's the cost of providing substandard education? What's the cost of youthful optimism or enthusiasm with life and only to find out there are no jobs after they get their education? What's the cost of the unintended consequences of human activities? Didn't mean to pollute, but oops, sorry about that. So what we start seeing is that people who are talking about costs say it said that opportunity costs must not be considered in decision. They are real costs, though, when it comes to global social systems. So an opportunity cost is the decision you couldn't make because you invested the money someplace else. So if you had done something different with it, you might have had a different result. But the problem is, once we make those commitments, we will bear the ultimate expense someplace in society. So the weaknesses in standard cost accounting is that it's just measuring the cost of doing. This is the result of that action. It doesn't measure the cost of not doing what Peter Drucker said. So what's the cost of not doing a continual improvement process? What's the cost of not inspecting receivable goods coming in for quality? What's the cost of not doing? We don't know those things. So we're only accounting for correction of failure commissions, not for the correction of failure omissions. So there's no penalty for not implementing Six Sigma projects when they should be implemented because we didn't do anything. But if we did the wrong project, then we say, oh, that was all wrong because we spent this money we shouldn't have. So standard cost accounting does not account for this. So opportunity cost is a benefit that could have been derived if the resource was made to apply in a different way. So standard cost accounting assigns costs to specific cost center, but when costs are easily assignable, but it really does not link to the bookkeeping records in terms of fixed structure, because some costs are assigned using informal ad hoc rules. So where is the cost of management? Where is the cost of if you will, variations that we can't account for a specific cost center? Well, that's smoothed out by a process that's called allocation. So allocation is basically saying if we can't identify the source of a cost, this is where it comes from. So business analysts have to investigate and find all of those opportunities for improvement in the invested assets. So it's easy to count what you can see, but it's difficult to count what you don't. So Einstein said, not everything that is counted counts, not everything that counts is counted. So it's the tip of the iceberg that's actually in the accounting system. All the stuff below the surface is not accounted for. So averages and summary data, which are used in accounting, distort what management can understand is wrong, and they actually distort the financial reports. So for instance, if I'm budgeting and I base it on last year's budget, last year I actually had a lot of waste. So I'm really, in essence, budgeting to have that waste repeated in the next year. So think about external costs and how do we evaluate these things. So there are economics in terms of the suppliers that we have, as well as our internal costs and also external economics at the customer. So often external costs with poor quality are greater than the internal costs. And we then totally ignore them when we're actually managing our organization. So Taguchi then ignored this goalpost mentality that at some magical line on a specification we met immediately from good quality to bad quality. And he says it's really a probability distribution function. And the less variation we have, the more dependable that we can be. So Schuhart specified that quality within a band is acceptable. And Taguchi identified three rules. He says, we can have quality where bigger is better. So more is better. So I want to have a bigger magnitude of a measure like revenue. I don't want to have a bigger magnitude of cost. That's smaller is better. So smaller costs, smaller defects, bigger revenue, bigger unit sales. Nominal cost, nominal is best, like on-time delivery. So quality in general needs to be designed so it minimizes loss to society after production occurs and the products are in public distribution. And so we take a look at what is the ideal state of performance versus standard cost. And we see that there's a whole bunch of losses not accounted for. those are the losses that we have to make up for with either quality improvement teams, lean methods, and so forth. And so the most dangerous kind of waste is the waste you do not recognize. And so one of the things we need to do is we have to visualize, see those wastes in the process. So that problem we have is we're operating in unit scales inside the organization. We have the level of defects. We understand we had a 5% defect rate. But what we have to think about is that if I have 5 to 7% defects, that means 93 to 95% the process is running as planned. Only 5 to 7% of the time is it doing something different. But the cost of that 5 to 7% of time is actually 20 to 40% on the cost scale of goods sold, because it's all the extra expediting, it's all the extra management attention. Those are overhead functions. They're not in the cost of the product. And it's also the cost of replacing the products, extra transportation costs. And usually that's at the high rate with Federal Express or some accelerated shipment. So the true cost of quality is not known, and it may be unknowable. And our problem is we're operating in two different scales: the scale of operations within the month and the month-to-month scale of the finances and money. So the budget we have is an estimate of comparing what we have to what we could be spending. And budgets may be either incremental or zero-based. And budgetary control is how do we actually plan expenditures and make sure we minimize waste in future operations. So we need to think about this. So one last section here, and I'm going to do this pretty quickly because it's a lot of formulas for you to go and study. But Henry David Thoreau said the cost of a thing is the amount of what I call life, which is required to be exchanged for it immediately or in the long run. So how much of my life am I willing to give up to have something? That's what Thoreau called true cost. So we say we can have cash flow, but working capital is the amount of liquid assets we have to pay for things. And Larry Bossidy made the comment, working capital is the single best measure of financial performance. He was the CEO of Honeywell, and he also wrote the book Execution, the Art of Things Done. He was the number 2 manager behind Jack Welch at GE before he moved to Honeywell. And we start seeing that we can understand lots of different things in the physical world. And real-time analysis of those things are all financially related, and they can enable us to understand financial efficiencies in the system. But if we start taking a look at these things, we start seeing to delivery time, for instance, it's output and actual plan versus actual input. So for working hours and so forth, operating hours, planned hours. So these rates are all coming out of these different components of observations that we have in the real world. And if I take a look at these, I have formulas for each of these, for production formulas and so forth. But all of those are based, if you will, on averages. And so we have to find what is a better way to do this. So one thing we have to take a look at is transaction costs. What is the actual cost of things happening? And that goes back to some work by the Nobel laureate Ronald Coase, who wrote about the problems of social costs, the nature of the firm. And take a look at those dates, 1937 and 1960. And we still don't do transaction cost accounting. Activity-based accounting, it came out with Kaplan and Burns in 1987. And that's where we're talking about the direct costs and indirect costs associated with the actual activities that created it. Well, we don't do that. We allocate the overhead everywhere. And what we do is we distort pricing and we distort profitability calculations by doing that. And we still don't do activity-based costing. Throughput accounting is taking a look at only material costs as the true variable costs. And so we start taking a look at this. We're basically not having labor as a variable cost anymore. It's basically a fixed cost. And as we do to more and more digitalization, we have less labor cost impact. And so this was in 1998, and we still don't have throughput accounting. So the accounting systems have resisted changes, even though there have been some fundamental critiques of how we go about using those. And there is no solution yet to this process. So what have we learned today? Well, John Dewey, who is the founder, or actually the biggest speaker, and I think most appropriate and important speaker about American pragmatism, said, man is not logical, and his intellectual history is a record of mental reserves and compromises. He hangs on to what he can in his old beliefs even when he is compelled to surrender their logical basis. And this is the problem that we're at today when we're trying to understand how do we put costs and understand using the methods of quality to improve the quality. What did we actually do in terms of the monetary and financial output? So, takeaway points from today. First, standard cost accounting is based on average data. It summarizes in times buckets, and that is not well aligned to the beat of productions. Standard budgeting practices act as a disincentive for continual process improvement because budgeting includes the cost of waste in the base case, which is coming from estimates from prior year, the waste that we had. Profit calculations funnel returns to the capitalist owners. All economic analyses, financial studies, accounting reports were designed to understand the benefits that the capitalist class derives from monetary transactions. And problems related to externalities and social costs are very poorly treated, and they're only painted with a very broad brush. So, an imperative of this century is reinvention of the financial ways and means to properly reflect the needs to invest in social infrastructure for universal improvement of humanity. Now, I want to share with you, just as a closing observation, something I have from my study of Japan and Japanese quality. And John Dewey said there are two limits of every unit of thinking that are perplexed and troubled or confused situation at the beginning, and a cleared up, unified, resolved situation at the close. And in Japan, there is three levels of lifetime learning. And we can help this to get an inventive total mastery of any subject. The first is called shu, which means to keep. And that means you can follow a discipline. You can do your work independently by yourself without coaching. This means you're adhering to the kata, or the way of doing as taught by a master. So this is an experienced black belt or somebody who's gone through, they know how to follow the Demaic process. Ha means to break or to adapt a job by analyzing and improving it yourself. And you're studying the master's kata and making it better or more applicable to your needs. So you're studying what needs to be done, and then you're applying it to your company, your industry. And re means to go away. And this occurs when you extend the master's kata by breaking away to create new philosophy or methods. And in this level, you can develop new knowledge and applications. And this is where we get science. This is where we start challenging old ways of doing things and creating a new way. And as Winston Churchill said, when the Battle of Britain was the air battle was being composed or won by the British in the 1943s, he says, "This is not the end. It is not even the beginning of the end, but it may be the end of the beginning." There's a lot of change to come. There's a lot more change we need to go. If we continue just to think of cost of quality as the only financial factor that's important to quality professionals, we will have made a serious mistake as a quality community. So what I've tried to do is offer in this presentation some ideas that would allow you to think, how can we do things in a different way? So thank you very much, and I think it's now time for some questions.
Oh, I'm on mute. I'm really sorry.
Okay. I was starting to think, where's everybody?
Thank you very much again. Once again, Dr. Watson. It's an amazing presentation, very comprehensive, very insightful. That's very fantastic. Now, we have some questions here from Sir Muhammad Iqbal Muhammad Hussain. Would you like to suggest some important ways to reduce poverty in the world?
Well, I think there are some things. One is we should understand what is a minimum livable wage, and how can we assure that we actually pay people according to the value a human life has. And a
Okay.
human life should be able to pay people for what they need to live in that society. So a minimum wage in the Philippines, and it may be very different than someone in New York City because the costs are
Yeah.
so different. But we have to understand
Mm.
that people need to be able to provide for their families the basics of life. And if the salaries we're paying is not sufficient for that, then what we start seeing is they leave. I remember doing a study in Singapore. We were putting a factory in a compact computer in 1991 in Singapore. And one of the things that I wanted to do was I wanted to have quality training for everybody. It was mandatory. And it was basically within the first 6 months, they had a month of training on different quality practices, both on the job and in classroom and so forth. And we found out that we had a very high rate of people leaving. And the reason that they were leaving, that even though we had a very good salary, because they had this extra training, guess what happened? They were getting about a couple of pennies more an hour someplace else, and they would move for that. And that caused us to realize that after we've given the training, what we have to do is we have to adjust their hourly pay, because now they have been trained, they're actually better, they're more valuable to us, and we should pay them more for that. So how many organizations actually increase based on your training and the value that you have to give to the company that increases your salary? Oh, not too many do that, right? So this is the thing we have to think about. Do we make decisions that actually value what people contribute? And if we do, then people will say, the company's good to me. And so if people can then get so they don't worry about this security, I need to have safety for my
Mhm.
family, food for my family, and so forth. So they can think about this, what Maslow called self-actualization. How do we become better? I think it's interesting. Yoshio Kondo wrote his book on motivation, and he said that motivation is stimulating people's desire to work. Giving them what Deming said, joy of life, which I mentioned, pride in performance, pride in what you do. And when you have that, and you actually have the financial stability in your life, you dedicate yourself with more energy to the work you're doing, and everybody feels better. Everybody wins. It's what we call a win-win situation. But if you create the situation where people can't survive and their families are structured in ways that everybody's just barely getting by or not getting by, you know, that's you've got a problem. Karl Marx in his economic theory said that if you want to control the society, keep them hungry, because if they're hungry, they won't worry about democracy. They'll just worry about where will they get food. But if we want to stimulate people's innovation, we want to stimulate their engagement, we have to make sure none of that basis is something that causes fear, but it allows them to relax and be able to think more clearly.
Wow. So many takeaways from you, sir. Okay, another question from Mr. Christian Tugade. What does the Tagochi loss function suggest about the issue of tolerance?
And I think he's talking about human tolerance of people or tolerance of products. I'm not sure which. But if we're talking about tolerance of products,
Mhm.
what Taguchi basically says is that our tolerance limits should be placed within the bands that are no longer going to be impacting customers. And the implication is that when we test a product and set a specification limit or tolerance limits, that what we should do is we should understand what happens when you go outside that limit. What are the penalties? So test
Mhm.
beyond points of failure, test beyond limits, and find out what are the implications so we can know what is the impact of that effect. And if it's a significant effect, we have to guard band, in other words, tighten the tolerance. And that's what the concept of the Taguchi variance management is all about, or variance reduction, as it's called.
I hope that Mr. Tugade noted all of those. Another question from Sir Muhammad. This is his second question. Dr. Greg mentioned in his presentation a book titled Total Quality Control. So he's asking for the author, sir, of that book.
Well, the author was Dr. Armand V. Feigenbaum. He wrote the book with that
Oh.
title in 1961, and then there's another edition that came after that. It's, I think, kind of archaic. It's an old book. It doesn't really represent what I would consider the most modern thinking. What I would recommend is if you're ASQ members and go take a look at the Quality Management Division. I've had a webinar series on there. I've got 16 webinars of an hour each that are available. If you're not a member of ASQ and you're on LinkedIn, join me on LinkedIn. I'll accept everybody who's got a quality professional into my LinkedIn account. There's some 11,600 people there. And all of those videos I've published on my LinkedIn account, as I will be putting this video up there. And my idea is that it's not about making money. It's about trying to describe today, what do we mean by modern quality? And so there's 12 lectures about modern quality that describe those principles and how they work. And then there's 6 more about macro quality, or how it expands to society.
Wow. You have a lot. You have a huge network, sir. I'll look for your account later.
Okay.
Okay.
We're happy to have you, Xander.
Do we have do we have other questions from our participants? Okay, I think there are no more questions coming up on stage. So now, at this juncture, Dr. Greg, may I present to you the Certificate of Appreciation for imparting valuable insights and inspiration to the participants during the Discovering the Financial Component of Quality on March 19, 2021. The Philippine Society for Quality awards this Certificate of Appreciation to Dr. Gregory Watson.
Thank you very much, Xander, and thank you very much, Ray, for inviting me. And it was my pleasure to be able to join you all in Manila today. So have a nice, wonderful, sunny day in Manila.
Yes. At this juncture, we are requesting our participants to please scan the QR code flashed in the screen or check the email we sent to you for the post-evaluation survey and consent form link. And all the participants will be given their certificates through email by the PSQ Secretariat. And at this point, may I present to you the Philippine Society for Quality's initiatives for 2021. True to our vision, we are continuously providing relevant training and certification activities which are responsive to the needs of the industries. Now that we have strengthened our vision and mission of the Philippine Society for Quality, we have invited renowned quality gurus through the years. We have partnered with different local and international organizations for collaborative projects, which will greatly benefit our members. And we also facilitate the highest national quality recognition for exemplary organizational performance of private and public organizations in the country. And we are the partner of the Department of Trade and Industry. We also promote quality awareness and practices in both private and public sectors. We also encourage the development of members in the areas of quality leadership and technology. In so doing, we recognize outstanding companies and individuals as a way of institutionalizing quality. In the past years, numerous companies were recipients of recognition such as Duran, Quality Manager of the Year, Benchmarking, and Best Practice Awards, and so on and so forth. And I'd like to take this opportunity to invite you, your companies, and your networks to attend the training activities flashed on your screen. These are organized by the Philippine Society for Quality. So, should you be interested, please get in touch with our secretariat or visit our website www.psq.org.ph for details. You can also visit our various social media accounts. And another event coming up this coming March 25, the Ugnayan Benchmarking Learning Activity. So these are exclusive. This activity is exclusive to our PSQ members. So if you are not yet a member of the Philippine Society for Quality, call our secretariat or visit our social media accounts so that you could get details on this one. We have another free online event this coming April titled Managing for Quality Amidst Digital Turbulence. Another international speaker, of course, we want the best for our members. And our 2021 National Quality Forum is already scheduled this coming October 15, 2021 with the theme Emerging Stronger Than Ever, Shaping the Future of Quality. You can reach us via our various social media accounts. Please visit and like these different sites to be updated of our activities. And we have come to the end of our webinar this afternoon. Thank you very much to all of you, especially to our speaker, Dr. Greg. Thank you so much, and to all the participants. And this has been your host, Dr. Zandra N. Maningas, the Vice President for Branding and Marketing of the Philippine Society for Equality, saying good afternoon and thank you.
Bye bye.